Hi all, this video is a worked example video for 7.7 and this exercise is about identifying inventory losses or gains and recording the inventory loss or a gain in a general journal, but also then updating a general ledger for this loss or gain. Let's jump into it. It's a relatively simple question. Here we have a little bit of data, which we're going to go through in a second, which tells us sales for the period, GST on the sales, and then the balance and the outcome from the stock take. This question has two parts, as I mentioned. Part A is going to ask us to prepare the general journal entry to adjust the inventory account for either a loss or a gain. So it implies we're going to have to calculate it. And it tells us the source document, which we know is important for a narration in a general journal. And then we have to consider all the above information to basically update the inventory general ledger. And it tells us that we have to balance the account. Although even if it didn't tell us, we would do that, particularly because it's important to finish off the ledger for the entire month. So let's jump in. We're going to use our knowledge of debits and credits at some stage. But firstly, we're going to have to calculate using logic whether we have, when we've done our physical stock take, whether we have discovered we have more or less inventory on hand. Now here we have two important bits of information. That's all we need to take into account. We've been told the balance of the inventory account, and we've been told that that is $27,600. We've also been told that during a stock take or inventory count, that we had $26,700 of inventory on hand. And that's actually all the information that we need. We've been told the sales, but that's almost been there to distract us, to maybe confuse us. In some questions it could be relevant, but in this case it's not. So we have to take into the consideration our knowledge of inventory count to work out whether we had a loss or a gain. We've been told our ledger says $27,600, but our count has $26,700 of inventory. And then we have to logically go which one is more accurate, the count or the ledger. Now the count is more accurate. So we have hence lost $900. How did I get that $900? We thought we had $27,600, but we have discovered that we have $26,700, which means we are down $900. Now, because of that, or the difference is 900, and we realize that we have lost that, so we have an inventory loss of $900. And it's always important to work this out, I believe, before we delve into the world of debits and credits. Some of you might already know the debit and credit, but I'm going to run it through. If we think about this, we logically have $900 less of inventory. Inventory being an asset, assets going down are a credit via the use of Paler, which some of you might use as a way to determine your debits and credits. We also must have a debit because we know our debits must equal our credits. And if we look at it logically, that will be because we have had an expense going up, and that expense going up is inventory loss. So then we delve into our general journal for this, and we've been told it is the 31st of December. In our account section, we know we just write the general ledger name, nothing more, nothing less. And convention says that we do our debit first, which of course was our expense going up, and we call that expense our inventory loss, and we know that that was $900. Our credit is the fact that our asset of inventory has gone down by $900. We've done our general journal correctly. We've made sure our debits equal our credits. Our accounts section only includes the general ledger name, nothing more, nothing less. And if we moved on, we would have missed an important part. because this question does not say the narrations are not required, so we assume it is. And then we have to write a brief description summarizing the transaction and also including the source document, which is actually the most important part. Being if they need to go find more information about this loss, find more information, they know which source document to go find. Now, because convention is that this is an end of the month, this is what we would call an adjusting entry. It's good practice to write, I guess, the perfect narration. So we're going to write adjusting entry, and then we'll describe it. And I'm going to describe that as for inventory loss, I'm describing it for inventory loss due to inventory count. Now you could do something different. The most important bit is I haven't got the mark yet. I need to really importantly write the source document, which of course here is memo 15. I've done part A. I now then have to consider all the impact to my general ledger of inventory. Now I like to think here, and just to make it a bit simpler, I like to write what type of element it is. I write that it's an asset, and then I know that my increases are going to be on my debit side, which is the left, and my decreases are going to be on my right, which is my credit side. Now there's not a heap of information to put in here, that we don't have specific sales or specific purchases, but we do know that we believed our balance was $27,600. But we know the accurate amount is $26,700, and we have been told to credit our inventory ledger, credit being right. So we're going to, and we know that this happened on the 31st of December. So we're going to write $900. The question being, what is our cross-reference? And we know that we are linking the transaction to the other side of the transaction. We're writing what the debit was for this credit, and the debit was inventory loss. And this is telling us there is a link to this transaction. Go to the inventory loss ledger to find the debit. And these are the two that we needed to do. Now we are told that we also need to balance this. So we follow the process of adding up both sides and putting the biggest on both. And that's easy here. We know that that is $27,600 because 900 is less than 27,600. We then realize our right-hand side does not equal 27,600, so we put the difference, which is 26,700. We are doing an official credit here, so we do a date and a cross-reference. But we break the cross-referencing rule because we know when balancing we just write balance. And then we have to bring this down to the first of the next month to write our opening balance, which of course is 26,700, following the rules where anytime you do a credit, you must of course do a debit. So guys, that is how you record a inventory loss or gain, in this case an inventory loss, in a general journal and general ledger. It's important that we follow the rules of debits and credits and twofold double entry accounting. So we're making sure that we are debits equal our credits. We're making sure that we're following the rules of general journals. We're following the rules of narrations. And that is how we accurately identify that.